Hello and welcome. Let's talk a little bit about probability and volatility as we continue among the series and profiting amongst small exchanges. And we're going to start off with probability, which is the odds or chances that something happens. And in this case, order fills or how one's portfolio values lie within, of course, their trading strategy. And with a lot of these codes and the big volatility, which is the next one, being aware of the numbers and play your strategy based on such, this helps very well in managing your gains and the portfolio. Because within these trades, there's going to be a lot that is available. And the math probability on small, medium, and phenomenal moves helps in one's decisions. All right, so let's move on forward. And I want to talk about buying back what you sold in the buy low, sell high strategy. And this is situations where maybe a market will fall 10%, 25, 33, 50, 60, and 75%. Now, as far as arbitrage is concerned, those major numbers don't exist. But we'll be talking in the next episodes about 25, 30% gains in one play. But if you're just looking to buy back and forth amongst the volatility, you're not going to get as many orders filled if you're looking to wait for like 60% declines compared to 25%. But the amount of gains you can get are a lot larger. Let's just assume you are selling 100 of a particular unit. If the market goes down 10%, and on the top it says 100% cross. What that means is the cross to your base currency. So say you're playing an altcoin like OK Cash or Peseta coin, or it doesn't matter, whatever coin it is, you want to just keep on buying for what it is you sold it for. If you buy it back after it goes down 10% and you sold 100 before, you could buy back 111 at the same price. And further down lower, you could at 25% decline, you could buy 133. And then as you can see, as the numbers start to hit the 33, 50, 60% mark, that you can be getting a lot back. And the gains can just exponentially grow larger when you use a lot of this strategy. So that's why if you're looking to try to make some gains, sometimes putting some number crunching together with a spreadsheet or with a pen and paper to see how portfolio strategies or what the expectations are or what you want to play for I think is a good idea. So I think there's three different ways of the buyback. You got the 100% on the cross, which means whatever you sell something for, you're going to use that exact amount to buy back. And there's also by always buying what you sold, increases are gained in base. So if I buy 100, sell 100, buy 100, sell 100, and just keep doing that, then I'm not really looking to increase on the cross currency, rather just using it to gain more Bitcoin, Ethereum, Litecoin, whatever the cross is. So in a situation where, say, for example, you have a 50% decline, if I'm selling 100 for 1,000 units, I'm going to buy back 100 for 500 units, and the other 500 are profit. Now, one of my favorite ones is going around half of each one, buying around half of the difference, which allows to increase both the base and the cross. So therefore, let's assume you're waiting for a 50% decline. That means if you buy around 150 rather than 200, you would get a gain of 50 units on the alternate coin and a little bit of a difference on your base currency. And within small declines, like 10% off, you might only gain about 5 tokens and a small fraction amount of gains in your base currency, which makes you wonder, is it even worth playing for the smaller gains? Sometimes the answer would be yes, if you are looking for more participation, more volume within your trades. I strive for larger gains because volatility presents itself as a realistic cash grab, what would be the results using a 0.2% trading fees, buying back both 100% base and cross, 200 tokens to start. So let's assume you bought 200 and you sold them all at 0.045. And then you buy back at 0.03 successfully. And then you sell, and buy. So just a few transactions. I'm going to put the answers up in just a couple of seconds. And in the situation, you could turn 200 into 921 if you were doing that first strategy. And if you were just doing buy 200, sell 200, well, then you would be doing obviously very well whenever you're able to make these plays. Now, if you're trying to do a game like this, where you're trying to buy it all back, it all seems like it's fine and dandy and that it's going to overperform the markets and make a lot of great profits. You're going to get into situations where obviously if you buy, maybe it just doesn't go up and it goes down. That's the obvious one. But even situations where you might sell, you might not buy back, and then the game or play would come to a completion. But it's always important just to realize, how do you want to execute your game plan? Because whenever you have a plan for it and you become a prepper, you're preparing for your methodology, your strategies and execution towards such, the better off you're going to be. And we're going to finish this off and move into the next episode. Is probably going to be 2, as I'm just going over the content in which I want to talk about within the art of arbitrage, which is buying and selling the exact same coin at the exact same time for a profit. Now, oftentimes you can see situations maybe with the main coins like Dash and Ethereum and whatever else. You can maybe get a small gain where one might be 5-6% higher. That's the more common arbitrage, if not even a 2-3% gains that are barely there. We're talking about major arbitrage gains. 20%, 30%, 40%, but definitely 9, 10, 12, 15% very easy, as well as even the larger ones. And this is, of course, with the small exchanges. So that will be coming out, the first one anyway, either Thursday or Friday. I'll try to get it done for Thursday, at least the first part of it. Thank you for tuning in and have yourself a great day. Bye-bye.